why this related to reporting season, and then I'll give you an amusing story from when I was a kid. But why this relates to reporting season is you need to prepare in advance, because on the day companies report, sometimes their share price does very funny things. A company reports a good result and the share price plunges simply because a few people thought the result was going to be even better.
Yeah.
Or the other way around, the company reports a bad result relative to what it has been doing in the past, and its share price rises because people thought it was actually going to be worse. Now, those are fabulous opportunities.
Welcome to this week's episode of Teaminvest Wealth Builder podcast. Here in Australia, we're heading into reporting season. So the majority of our ASX-listed companies will be reporting and are due to report by the 31st of August. I've got a special guest here with me today, Howard Coleman, who is the co-founder of Teaminvest. Welcome, Howard. It's lovely to have you here.
Thanks, Kerry. It's good to be here.
You've been running a session across our masterclasses over the last month, and you related this period, or getting ready for this period, to a Girl Guide or a Boy Scout using a slide rule.
Yes.
Now, I found that really interesting. But for our audience who, may not know what a slide rule is, should we start the conversation with what is actually a slide rule?
Yeah, that's probably a good idea. And I deliberately entitled it something that would cause people to say, what? If I'd just given it a fairly boring heading, like reporting season's coming up, we should talk about it, that would have been fairly boring for our members. But a slide rule was an extraordinarily useful tool that predated calculators.
Okay.
So before we had electronic calculators where you could punch a few buttons and work out all sorts of amazing calculations in no more than a couple of seconds, scientists and engineers and anybody who needed to do a lot of calculations had a thing called a slide rule. And in fact, had I known you were going to ask me about that, I would have actually brought mine in, because I still have one. It's in a drawer at home. I don't think I've used it in 40 years, but it's sitting in a drawer at home. I've never thrown it away because I always thought it was such a useful tool. So what you could do with a slide rule effectively was pretty much any calculation that you can do with a calculator today,
Okay.
including things like trigonometric calculations, calculus calculations, the normal mathematical calculations like adding, subtracting, multiplying, dividing, financial calculations, net present value, all these sort of things. As long as you knew the maths behind it,
Okay.
you could do that on a slide rule. And in my era, every engineering student, every science student, I was a science student, I majored in physics and maths, walked around with a slide rule in their bag, because there was not a day that you didn't have some need to use your slide rule. So that's the background. Now, why a slide rule is one of the disadvantages. By the way, I'm super pleased that we, in the end, got electronic calculators and computers instead of slide rules.
So am I, just quietly.
Absolutely, they're easier to use. But without a doubt, one of the big advantages of a slide rule has become a disadvantage when using calculators.
Okay.
And what I mean by that is let's take the calculator today, the number of times people get a wrong answer on a calculator because they did something wrong but don't realize they did something wrong, what we call fat finger.
Yes.
You hit the button twice by accident, or you hit the button next door at the same time as the button you were trying to hit. We've all done these sort of things.
Absolutely.
Or you got the decimal point in the wrong place. But we don't prepare in advance because the calculator is always right. And that's true. As long as we don't make a mistake, the calculator is always right.
But there is still that human error, right?
Absolutely. And I've had, over the years, I can't tell you how many times somebody's either presented me a spreadsheet or some calculations they've done on a calculator, and at first glance I've said, this can't be right. the number's too large or the number's too small. This just can't be right. Now, with a slide rule, you had to do two things in preparation before you started sliding the thing back and forth and doing your calculations. The first thing is you had to do an order of magnitude calculation. Now, what I mean by that is the answer going to be, say, 2 digits long, 3 digits long, 4 digits long? How long is the answer likely to be before the decimal point? In other words, is the answer going to be 2 or 20 or 200 or 2,000? And you at the same time, therefore, had to do an approximation. Is this going to be 2,000 or is it going to be about 5,000? And the reason you had to do that is the slide rule didn't tell you where the decimal point was going to be. It gave you the numbers. You had to put in the decimal point. The second thing is what the slide rule didn't do is tell you which end you needed to read it on. So if you didn't have an approximation of the answer and the answer was something starting with a 2, for example, and you read it off the wrong side of the slide rule, you got an answer starting with a 5, the inverse of 2. If you think in terms of 2 times 5 is 10. So the two risks with using a slide rule is, one, very commonly, you read it off the wrong side of the slide rule if you hadn't worked out the answer approximately in advance. 2, you put the decimal point in the wrong place. So what you learned very quickly, even as a first-year student in your first semester, is before I do anything on the slide rule, I've got to do a quick mental calculation of roughly what's the first number in the answer likely to be, and secondly, what's the order of magnitude? How many numbers are there going to be before the decimal point? Now, in other words, you had to prepare. And providing you prepared, a slide rule was a wonderful tool. Unfortunately, we don't need to prepare today with calculations. We do it on a calculator. You could argue we should, but we don't.
No.
We rely on the calculator, we rely on the computer, so we go tap, 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 and we say, that's the answer. And, as I say, sometimes the answer comes out wrong. Why this related to reporting season, and then I'll give you an amusing story from when I was a kid, but why this relates to reporting season is you need to prepare in advance, because on the day companies report, sometimes their share price does very funny things. A company reports a good result and the share price plunges simply because a few people thought the result was going to be even better. Or the other way around, the company reports a bad result relative to what it has been doing in the past, and its share price rises because people thought it was actually going to be worse. Now, those are fabulous opportunities. If you are prepared and you know what you're expecting the company to report approximately, what it's been averaging over the years, and therefore what is good and what is bad, not just what people think may be good or bad, what actually is good or bad. For example, if the company's been growing 10% a year and it grows at 9%, is that bad? Not really. It's still a very good year. They grew 9%. But if you were expecting 10 and you're a fund manager, you may say it's a bad result without thinking a little bit more deeply and saying, hang on, 9% growth is still pretty good. So on the day a company reports, often the share price goes in the opposite direction of what would rationally make sense. Company's done well, share price drops. Company's done badly, share price increases. Now, this only happens maybe in 1 in 10 companies or so. It's not every company that reports. Out of the 30 or 40 companies we watch, there are usually 3 or 4 that go in the wrong direction up or go in the wrong direction down. But for our members at Teaminvest, it's a marvelous opportunity. The company reports increased sales, increased profits, and its share price drops 15%. Or what a fantastic opportunity to buy. Or you own a company and you're thinking, I'm really not happy with that company anymore. They've changed their strategy. They've made an overseas acquisition. They've taken on debt. I wish I could get rid of this company. I wouldn't mind getting a better price for it. It reports not particularly good result, and the share price goes up 10 or 15%. What a marvelous time to sell. And the reason, Kerry, preparing is so important doesn't usually last. Because what happens, the share price drops, everybody has a deeper look at the company saying, why did the share price drop? Then they realize, hang on, it was a bit silly that it dropped. Okay, it only reported 9% growth instead of 10% growth, but it's a bigger company than it was a year ago, and the share price goes back up again, or the other way around. So if you don't act quickly, you don't get the benefit. You can't pick up the bargain. Without preparation, it's highly unlikely you're going to act quickly. So what we spoke about in our Teaminvest meetings is the sort of things you could do to prepare. For example, in all Teaminvest Smarts, as we call them, where we look at a company in depth, we spend about 3.5 hours discussing the business. And among the things we discuss are, what are the main risks this company is subject to? What are the main moats that it has that protects it from competition? Now, when the company reports, if you've got a note of the perhaps 3 high-scoring risks and the 3 high-scoring notes, and you read the chairman's report and the CEO's report, and something in the report suggests one of those risks have triggered, if I give a very simple example that we said, there's a key man risk. We believe the person in charge of the company, who, by the way, could be a man or a woman, we just call it key man risk for simplicity. If the person in charge of the company we consider to be that important that if they left, it would be a risk to the company, and we read in the annual report that Mrs. So-and-so or Mr. So-and-so, our CEO, has unfortunately been diagnosed with an illness and will be retiring from the company within the next few months, and we're looking for a replacement. That risk is now triggered.
Yes.
If we were aware of that and we'd already discussed it and we'd looked at, in this particular company, did we think that was serious or not? There'll be some companies where we'll look at and we'll say, well, even if the key person left, the next level of, it's such a big company that the next level of management is so strong that any one of those could take over, versus this is a company that's been pretty much a one-person show, and without him or her, that company will probably be a lot weaker than it was before. If we've thought about that in advance, we know how to react when it reports. So preparation is key, and preparation isn't just looking at a number, but being prepared. So relating it back to the Girl Guide and the Boy Scout, what was the Boy Scouts' motto? Be prepared. And the Girl Guides, be prepared. And why a slide rule is all of this is approximate. You don't spend hours calculating if it increases earnings by 9% versus 10%, how much difference is that going to make over 20 years? Because the 9% was 1 year. Next year it may improve by 11 and average out at 10 if it's been averaging 10. The future is always indeterminate, and doing exact calculations about the future is the same sort of thing as using a calculator with a potential fat finger, because you don't know what's going to happen in the future. All you can do is make approximations, which is being prepared before using your slide rule. Make sure you have an approximation.
Following the incredible success of our standout event in Sydney earlier this year, we would like to extend a warm invitation for you to attend the Emerging Wealth Winners Conference, Melbourne 2025. This event will be held in the iconic MCG Members Dining Room. We're bringing together a standout lineup of only 7 curated ASX-listed CEOs to present the insights, the knowledge, the shared wisdom, and the strategies that help inform investors making wiser decisions on when and where to invest into. This event is sure to be jam-packed, full of the knowledge and the wisdom that you're seeking, and we encourage you to register at tipgroup.com.au. Check out the events page, and we look forward to seeing you there.
I mentioned earlier, I'll tell you an amusing story from when I was a kid. I was about 10 years old, and there was no television in South Africa at the time. I was an only child, so I didn't have a brother or sister to play with. And we lived in an apartment building, and in the apartment building, there were no other kids. It was only a small apartment building. There were no other kids. So in the evening, I generally had nothing to do to amuse myself that I couldn't do on my own. And one of the things I did often was listen to the radio.
Okay.
And well, I didn't really care what was on. I just listened to whatever was on, And among the various things was the news. And one Easter weekend, listening to the radio, sitting in my bedroom, I heard on the radio that with all the cars going to the coast, I lived in Johannesburg, about 600 kilometres from the coast, with all the cars going down to the coast for the Easter weekend to enjoy the seaside, there were 2,000 cars a minute passing through a particular town called Ladysmith on the way to the coast. And I thought, 2,000 cars a minute? That can't be right. So I thought, how long is a car? And I didn't know exactly, but I sort of thought, well, a car's about as most of the length of my bedroom. So how long is that? Maybe 10 feet? I don't know. That's probably how long a car is. When we go in our car, how close are we to the car in front and the car behind? Well, there's usually more than one car distance between the car in front and us, and more than one car distance between us and the car behind. So I did a few mental calculations, the approximations I was talking about before, the slide rule, and I worked out it can't be right. There can't possibly be 2,000 cars a minute passing through there. It's only a one-lane road. So I went to my dad and said, I heard this on the news and it's wrong. It can't possibly be right. So my dad said, well, let's check your calculations. And we sort of checked them. And my dad said, yeah, that's absolutely impossible. Can't possibly be right. So he said, you know what I think you should do? Phone the SABC. SABC was our equivalent to the ABC, national broadcaster. Phone the SABC and ask for the newsroom and tell them. Anyway, I was a bit shy about this and he encouraged me and I phoned and I said, by the way, I'm a 10-year-old schoolboy and I heard this report and I don't think it can be right. I've done some calculations, it can't possibly be right. And I explained why. And the newsreader said, gee, that's interesting. Well, we've got another broadcast coming up in 45 minutes' time because they had the one an hour.
Right.
I'll phone the police in escort because we got it from them. I'll phone the police in escort and double check. So anyway, I said what it could be is there could be that many per hour going through escort, but not per minute. So he said, well, I'll phone and check. Anyway, a little while later, my telephone rang and my dad said that maybe the SABC phoning you back. He said he'd phone me back. And I picked up the phone and I could hear laughter in the background. I thought, oh my God, I've got it wrong. I'm going to be really embarrassed. And he said, by the way, I just wanted to tell you, Howard, we phoned the police and the police said, I had said the only way it was possible is if they were doing more than 500 miles an hour. You see, only then would it be possible. He said, we phoned the police and we told them that, and that the only way it would be possible would be if they were doing 500 miles an hour. And the policeman said, well, sir, don't worry about it, because if that is the case, our officers on the spot will apprehend the culprits. Now, that's like the spreadsheets and the calculations I've had from people over the years. Somebody will send me a spreadsheet and say, look, Howard, this company is worth X number of $1 billion. Why? Well, if it grows at that rate and this happens and that happens and they extrapolate the spreadsheet onto many years ahead, then the company is going to be worth whatever. And I look at all the assumptions they've put in and I say, but hang on, that assumption there is somewhat peculiar. You know, some of the other assumptions look right. But if I say to them, it can't be right, they say, I've checked all the formulas in the spreadsheet and, you know, it's Microsoft Excel. Microsoft Excel doesn't make mistakes. No, Microsoft Excel doesn't make mistakes, but the human that uses it can very often make assumptions about the future that are incorrect. Yeah. John Price, who's also one of the founders of Teaminvest, has run an amusing exercise with members several times over the years. He takes an example of a company that's really well known, say a Woolworths or a NAB or a company everybody knows.
Yep.
And he says, let's use a discount cash flow valuation and work out what this company is worth. The standard things that analysts are always taught to do using DCF. And he says, what's a reasonable assumption for Woolworths' growth rate? And everybody in the room will say a number and we'll pick and John will pick the number that's the most common number in the room, and he'll put that in. What's its P currently? And he'll put that in. Then he'll say the various other inputs. I won't go through them, they'd take too long with. They'd go into a DCF calculation, but they're 3 or 4, sometimes 5, depending on the kind of calculation you're doing, assumptions going ahead. Everybody happy with those? Yep. Plugs them into a DCF, which goes all the way out to infinity.
Okay.
That's why it's such a silly thing to use. All mathematicians see calculations like that and are horrified, but people who aren't mathematicians but studied finance or economics don't realize the instability of anything that uses infinity in the formula. And you'll get a valuation for Woolworths that's ridiculously high or ridiculously low, maybe $200 a share or $10 a share, and the share price is currently 30-something.
Right.
So then John says, oh, well, obviously we've got this wrong. We've been too optimistic. Let's say it came out $200. We've been too optimistic. Let's cut each of these down and be a little bit more pessimistic. How about if we changed our growth rate from whatever, let's call it, we had 4% and changed it to 2.5%. And what about if we had so-and-so and we changed it to so-and-so? Everybody in the room says, yeah, that sounds reasonable for each of the individual assumptions. And then he puts them back in the spreadsheet and it shoots off right in the opposite direction, $10 a share. In other words, if you're going to do a DCF calculation on a company, you need to know the share price first so that you can play with your numbers that you put in to get an answer close enough to reality. Or as Andrew, when he worked in Credit Suisse one day as a very junior analyst, told me over the weekend, he said, Dad, I've realized the most important thing you have to do. And I said, what's that? He said, when your boss comes to you, he was only very junior, when your boss comes to you and says, do a DCF calculation or valuation, if it wasn't DCF, do a valuation on XYZ listed company. The first thing you had to ask is, are we on the buy side or the sell side?
Okay.
Because if we're on the buy side, the valuation better come out lower than the current price. If we're on the sell side, the valuation better come out higher than the current price. Otherwise, your boss is not going to be happy. And by tiny changes in the assumptions, minute ones, you get completely different answers.
Wow.
Now, changing the subject for a moment, and don't get me wrong, I'm not suggesting that I don't believe that the world's climate is changing. I do believe the world's climate is changing. I also believe humans have had an input into why it's changing. So I'm not a climate science denier.
Okay.
I'm a climate model skeptic because I laugh at the calculations.
Okay.
With anything more than 3 assumptions in a large set of calculations, you can pretty much get any answer you like. And the climate scientists brag that their model uses 200 plus assumptions. Now, with 200 plus assumptions, you could show that the Earth is going to freeze all the way to the equator in the next 50 years' time, or is going to cook as hot as the sun in 50 years' time. So how do they get a calculation that comes out with, say, 1.5 degrees or 2 degrees or 3 degrees, a small number like that? Easy. They know the number they want to get approximately in advance, and they amend the assumptions until they get the right answer. Now, I'm not saying they're doing this to be evil. They're doing this without realizing the effect of doing it. So my point with the slide rule, coming back to it right at the beginning again in preparing for reporting season, is in doing your preparation, do some approximations.
Yeah.
Know what you're looking at. And then when you know what you're looking at, you will recognize whether you've just been offered a bargain by Mr. Market or you've just been offered a fabulous opportunity to get rid of a company you don't want to keep. Now, there may only be 2 or 3 companies you don't want to keep, but at least you know what you would be happy to sell them for or happy to buy another company for. So that was the slide rule and the Girl Guide and the Boy Scouts story.
That makes sense. That makes sense. So I think you've covered a lot of things there. So I think the big things that kind of stick out to me is, one, I just want to remind our audience that here at Teaminvest, we're long-term investors.
Absolutely.
We are not traders.
No.
So when we talk about being prepared and we talk about doing our smarts, we're talking about that we spent time really understanding the companies and digging into the companies. And they're the smart reports that we're talking about that we've looked at before we've even invested or considered investing in a company. So we're talking about being prepared for when this reporting season comes up, like you had to do with the slide rule, looking at those reports and having an idea of where it should land and where we expect it to land.
And in fact, there's an extra interesting thing that's worth saying as well. We've got around about 600 plus members around the country.
We do.
They all look at those companies in their own way in depth. Now, these 600 people have all pretty much been successful in life. They're investing their own money in the companies, and there are a very small number of companies that pass all our requirements to even be looked at.
Yes.
So there's about 30, 40, occasionally 50 companies that we know in great depth, which means probably compared to anybody else out there in Australia, that small number of companies we know far better than all the other experts put together, because there wouldn't be 600 people looking at any one company who are so-called experts. On the other hand, we don't know the other companies at all. And the reason we don't know the other companies at all is they don't pass our basic filters. For example, 2/3 of all the companies on the stock exchange don't make a profit. So we don't even bother looking at them.
Yeah.
Now, they may turn out to be good investments, but that's a bit like saying, next year North Melbourne may win the AFL or West Coast may win the AFL. It's not an impossibility, but you'd rather put your money on one of the teams that came in the top 8 this year to win it next year than the team that came bottom.
Absolutely.
It's that sort of thing. And our members are looking for the highest probability of getting 15 to 20% return per annum on average over a long period of time. And as you say, we're not traders, so we're not looking at what's going to happen tomorrow, but reporting season gets us an opportunity to get some bargains or get rid of companies that we don't want to own more easily than at the rest of the year.
Absolutely. Look, thank you so much for joining us. It's been
Pleasure.
really, really insightful. And I hope you've got some takeaways that you can prepare for reporting season as it comes up. Thanks again, and I'm sure we'll see you again in the very near future.
Lovely. Thanks, Kerry.
The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.